Okay guys, and welcome to today's video. Today we're going to be looking at how to understand and master market structure. So as you can see on the screen, top secrets, yes, because the information I'm about to share with you is very unique. Not everyone is talking about it, and it's a concept from my mentor and actually also my own approach to viewing market structure. And it's something that is very priceless, so that's why it's a top secret. Is a classified stuff uniquely to me. So I'm going to be sharing it in a moment very soon. So all I expect of you is stay true to the end of the video to be able to really understand how to master market structure. So moving forward, when we talk about market structure, let's see how a retail minded trader is going to view it. So a retail minded trader and a newbie in trading will view market structure in this pattern. For instance, now what we have here is a bullish market structure. They want to see price move in higher highs, higher low, higher highs, higher low, then higher highs. Then this sets to the tone that the market is in a bullish tone. You understand? Okay, now we're in a bullish market structure, and they're going to start looking forward to buying opportunities, which is very good. So moving forward, this will be more like a complex bullish market structure where price made higher highs, then we have peaks and troughs, then making a lower low lower than the previous two lows, then taking high and making a lower low again, then going higher highs above the previous higher high, then making a lower high, then eventually making a higher high. So they will be viewed as a more complex market structure, which majority of us experience maybe on a day-to-day, on a week-to-week basis in the marketplace. So moving forward, for a sell market structure or a bearish market structure, this is going to look like classically a lower low, a lower high, a lower low, a lower high, a lower low. And retail minded traders or a uninformed money trader will just go into the marketplace and start looking forward selling opportunities in the marketplace. So why for a more complex sell or bearish market structure, this is what it's going to look like. We're going to have a lower low and peaks and troughs making a lower high, and automatically a lower low, a lower high, then a lower low that takes out the previous lower low, then a lower high again, then automatically a lower low. So this is how a complex bearish market structure is going to look like. So we're going to take this context, this particular example, this particular way people generally view the market structure to be. Then we're going to apply it in a chart. We're going to see an example. We're going to apply this same pattern and approach and see how we want to compare our win rates and want to compare our risk to reward opportunities and how many trades we're going to be able to catch. So in the next slide. So right here, this is an example. So this is a recent price action. Actually, you can go and view it on the AUD UXD. Is on the Aussie dollar pair, the 4-hour time frame. So it's a recent pair. So based on the time we're recording, today is 8th of July 2022. So you can still see this particular market structure which just unfolded, which I'm going to analyze in a moment. So if I ask also we can see happening with this price action already printed, majority of us and none of us will argue that this is a sell. This is a bearish market structure. Price has been making lower lows, lower high, lower lows, lower high, down to this point over here, which is very good. So let's just say this is where we met price. We came into a new day and this is where we met in price. So we want to apply the classic market structure approach and see our rewards and returns. So let's just say we move forward, we waited for price and price printed this. You understand? So what has happened now, the structure has changed. Why? Because we have seen this particular high over here being taken out by this bullish move upward. Good. So what are we waiting for? We're waiting for a retracement downward to be able to better time our entries. That's the way we're going to view it from the retail perspective. Is that also? So and we waited for price and price printed this, even giving us a bullish engulfing pattern. So this is our entry. So we entered here with a buy and we wait for price. So why are we looking to exit price? Probably for a high potential risk to reward. We want to take our profits right here. Is that also? But for those of us that are not too greedy, we want to take our profit right here. Good. So let's just say we want to take our profits right here, and this happened. So we're in profit right now, and we are still expecting higher prices. We're expecting higher prices in the marketplace up to where? To this point in price, to this price level. But all of a sudden, price printed, and this is what we have. Now we are out of that trade, provided we put our stop loss right below this low right here. So now this sell move took us out of the market. So that's already a loss in the marketplace using the classic market structure approach. So now we can say, okay, that is a loss. I take that loss, I absorb that loss, but we are still in a bullish trend. We are still in a bullish trend. Why? Because this the origin of this market structure right here, this origin right here has not been violated. So this is still the lowest low, and this low that came down here has not taken this low. So we're expecting what? Higher prices. So now with what we see in price here, we can use this as our entry and look to take our position above this high. Is that also the classic approach? And we watch price print, but price didn't get to that high. Price just went to the midpoint level of this particular range here, and all of a sudden traded downward, knocking us out again of the marketplace. So that's two loss already using the classic market structure approach. You understand? Using the higher highs, higher lows, and the complex market structure approach. So now we're still on it where we already have two loss already. We absorbed two loss already. So now let's say we enter into the marketplace again. Mind you, this is the 4-hour time frame we're using for this analysis. We enter the marketplace because right here we can see what's a bullish engulfing. So we enter here expecting to take our profits over this high or over this high. Is that also? And we saw price points but went lower. That's the third loss in a row using the classic market structure approach, higher highs and higher lows. And now, but we're still in a bullish market structure. Why? Because we saw that the structure shifted at this play point. Is that also good? And this lower low is not yet taken out. So using the complex market structure approach, we are still in a bullish market structure. So maybe price is coming for lower price level to give us that spike up in price to our potential objective over this high here. So we enter again now, the fourth trade in a row, and let's see what price did. Price went higher. So we are practically in a profit right now. And what we can see right here is that above this high, this particular candle took out this high. So we're probably in a confirmed bullish market structure. So price, we can assume now using the classic retail minded market structure approach, you can assume, okay, price just came for lower lows. So these three losses we had is understandable. We didn't take in consideration that price was going to come for lower prices. So now we are expecting higher prices. From this point, we don't want to see price go down. Is that also? That is how we approach the classic retail minded market structure approach. And let's say we are still in the profit, we see all the traders. Some of us will be looking to put in more orders to be able to mitigate the losses we had over here. And price printed this, eventually taking us out on the fourth succession in the marketplace, giving us 4 losing trades, 4 losing streaks in just this particular piece of price action. And we are like over our heads, we are annoyed, we're angry, we feel like breaking our computers, we feel like smashing the chart, we feel like killing and squeezing the market maker's neck, and we feel like doing a lot of things, and we're very, very angry. Why? Because we use the normal market structure approach, either trying to change your character. Maybe some of us will probably be using moving average or trend lines, and probably some of us using trend line. Our trend line would have practically just shown us an entry right there. Probably, let's say we took this was our trend line. So probably some of us using a trend line would have switched gears and start selling the marketplace. Or probably some of us using a moving average. Let's say we're using the 50 MA or the 200 MA. Our moving average will cross this way, and probably that's for the 200 EMA. While for the 50 EMA, we'll see price cross like this, and probably now those of us using the EMA will be like, wow, the moving average works. It's thank God I had the moving average on, and you'd have be very happy with your moving average, because probably you, though you had two losses over this region, at this point you're able to know that the structure has changed, and you joined in, and later on you saw price printed lower prices in the marketplace, and you are very excited that you switch gear using your indicators, your trend line, your Wyckoffs and the rest. Good. But what if I told you that there was a better approach? What if I told you you don't need your moving average, you don't need the trend lines, you don't need any of that to predict market direction, to predict market structure efficiently? What if I told you just need one single thing? What if I just told you that all those noise on your chart are not relevant? All those ideas of market structure that you have, though they are relevant, they have made you some money, but in the real world, in the way banks trade, they don't care about that your market structure, lower highs and lower lows. They don't care about that, because they're actually the ones actually creating those movement, those structures in the market. What if I told you they don't actually observe that your market structure? Would you believe me? So the question will be, what do you actually need? What do you actually need to focus on? What is that one single thing, an element you need to have at the back of your mind when looking at market structure? That thing is liquidity. What you need to have at the back of your mind is just this one single factor, liquidity. This is the way my mentor teaches it. All you need to do is liquidity. Where is liquidity in the marketplace? To the buy side and to the sell side, where are the liquidities? Where's the buy side liquidity? Where's the sell side liquidity? And when we already identified these liquidities in the marketplace, we are having an edge already to be able to make money in the marketplace, and we will get sync in the market direction, in the right market structure. You understand? So what are these liquidity? They are the fair value gap, imbalance, order blocks, and liquidity bulls. So these are the areas of liquidity, either on the buy side or on the sell side, that we should pay attention to, because these are the liquidity pools and areas on your chart, either on the buy side and the sell side, where the market maker, smart money, is going to move price to and create those market structures you see appearing on your chart. This is all those higher highs, higher lows you see on your chart are actually created by price moving either from a fair value gap into an order block, to a liquidity pool, to an imbalance. So all those market structures are created because of price is going from one liquidity to another liquidity, from the buy side liquidity to the sell side liquidity, from the sell side liquidity to the buy side liquidity, and that will create the market structure that you know. So any other context you are applying, whether it's the change of character of the market structure, whether it's the Wyckoff theory, or whatever theory you're applying, using your trend line, moving average, whatever strategy you're applying, you must bear in mind, you must factor in these liquidity areas, because this is what actually creates these market structures actually see happening. So how do I use this market structure? So now this is where my own top secret comes in. That's my own approach. So that's why I say this is a top secret lesson. So where does my own top secret approach come in? How do I use this liquidity? Now I know this thing. How do I use it? So that's where my unique trading style comes in. I call it the refer to target mentality. So these are the way you should approach the marketplace. Now, how do you use this refer to target mentality? For instance, now let's say we're in a bearish trend. You understand? And price had sold and price made a higher high, breaking a structure. We are not considering that a bullish move. All we want to see is, what is the area of liquidity? Are we seeing a fair value gap? Are we seeing a liquidity pool? Are we seeing an imbalance that price is trading into? And once price trades into that particular thing, that now becomes what? A refer point, or a reference point rather. So that's our refer point. So once price trades there, all we're looking for around that region is a selling opportunity in the marketplace, and now inform us on the next direction, which will be the target point. Mind you, the strategy, the approach is the refer to target mentality. So once price refers to, let's say, the fair value gap, all we want to see price do is target another area of liquidity. Now let's say now this particular area of liquidity targeted was on the buy side, which is the fair value gap on the buy side. All we want to see price target next is either a liquidity pool or an imbalance or probably an order block towards the sell side. You understand? And then probably some of you are like, it's okay. Isaiah, give us example. I'm going to give you example just in a moment. So using the same example we used for the retail-minded approach for market structure, we're going to use that same example for this refer to target mentality and using the liquidity areas on the chart. So now this market structure, let's just say we happen to come into the price chart and we have seen price printed this already. So price has made in series of higher lows, lower lows, lower highs, lower lows, lower highs, up to this particular region right here. Good. So we saw price make a movement just like this, and what we want to think of as a liquidity based trader, as a smart money trader, what we want to think of is we want to know, okay, what took price from this lower point to this up point. But now, with the kind of price action we have on our screen right now, we are not entitled to that kind of information. You understand? Because actually I can explain why price actually displays using this particular piece of price action, but I don't want to go into great details because I don't want this video to be very long. I just want to use, let's just assume that price just displays from that low to that high, and this was what we're waiting for. So we want to see this expansion higher. So now we saw this expansion higher. The question is, where exactly did this expansion trade into? If you look over here, you can see a high. You can see a high, a swing high over here, right here. And above us here, we can see what? A fair value gap. Why? 1, 2, and 3. So this space here is what? A fair value gap. And over here, you can also see what? An order block. A 3 bull pattern order block. That's what we see right there. Now, price has traded where? Into what? This particular high over here. Now let's see the response in price. So here now becomes a reference point. So let's say we're so confident enough and we sold here. What will be our target point? What we see here, we can see what? An imbalance. This is an imbalance right here. And below here is what? An order block. Just right here. That's an order block. So let's see what price does. Price trades where? Into what? The imbalance. This imbalance right here. And also tap it into what? The order block right there. So now, this our target point has now become what? A refer point. So are you seeing how it is switching? It's just once this is black, the next point should be white. Once that we get to the white point, that white point becomes black, the next point becomes. So it's a very simple approach, and you don't even need complex of other things to be able to use this approach to identify market structure and trade in the right direction of the market. So now this our target point now has automatically become our refer point. So now we are going to buy here, looking to take our profits here at this target point. Why? Because this is now what? A liquidity pool, and above this place too is what? Our fair value gap. Is that also good? Let's see what price does. Price trades into what? The fair value gap. So we've had 2 trades in a row using the refer to target mentality liquidity approach to market structure, and we've made 2 successful trades already. So now these target points, now we can wait to see a response in price either on the lower time frame to see if we're going to take sell trades or we're going to continue expecting buy trades. But at this point in market structure, price has referred to this target area which we have lined up in Asia, which is in liquidity context. This is what? A fair value gap. Now this has automatically become what? A refer point. So price can decide to trade higher or trade what? Lower. We don't know yet, but we can anticipate that based on the response in price when we are waiting for watching live action. You understand? I won't go into great details in this video, but I just wanted to understand the refer to target mentality. So let's just say here becomes our refer point, and we are so confident enough that price is going to sell, and we took a sell trade at this region where our price is currently. Where will be our target point now? Our target point could be this order block right here, could be this liquidity pool right here, or could be also this liquidity pool right here. So let's see what price actually does. Price trades straight up into where? The liquidity pool right here. You understand? So now using the refer to target liquidity approach to market structure, we've made 3 successful what? Trades. let's continue and see what pans out. So at this region two, what happens now? We've tapped into a liquidity pool, and this liquidity pool, which was once a target, has now become what a refer point, a reference point. So now, what will be the likely place to target? We can target this high over here, or this up close candle, which is what an order block. That is the open price, and this is probably the low price. So one of these three areas should be where price should target. Since we are now referring from this area. So now we have a buying opportunity. We can see the response in price going higher. So let's say we enter a buy trade there, and all of a sudden we saw price come into what the low of this particular order block. So let's say we're not greedy and we took our profits there. Probably this sell movement downward wouldn't have affected us. But let's just say we took a loss right there. Let's just assume we took a loss right there. We're too greedy. We wanted price to get to this high using the refer to target mentality. Price now has traded where? Into another what? Into another area of what? Of liquidity, which is what? Now, which was what a target, but now has become what? A refer point, a reference point rather. And why I'm using the word refer so that you understand the refer to target mentality. So let's just say we took a buy trade. What would be the likelihood to exit our trade? We can see what a fair value gap just above this high here. We can see what an order block just above here. So mind you, we had a losing trade. We're assuming we took a losing trade here because let's just assume we are greedy and we didn't take partials. So price came against us using the refer to target mentality, because you definitely have losses sometimes because of greed and fear and the rest. So let's just say we took a buy trade here and we expect to take here to mitigate the loss we had over this region. So let's see what price did. So price trades into where? Into the fair value gap and automatically into the order block. So we would have taken our partial there, would have taken a profit there. And let's say we took half the portion of the trade we lost in this region right here. We took a portion of this trade out that paid us back for the loss we had at this region if we're using proper risk management. So let's see what price does later on from here, because mind you, here there's a target now could now become a what? A refer point, a reference point rather, and price could target small lows like here and automatically probably this low here, or price could trade higher to this region here. But let's just say we knew that here was going to become a sell, because we can see that price has rejected more lows based on liquidity, and we can see based on this candle printing right here, this particular candle, there's a indecision in the marketplace and price does not show more willingness to go higher. So let's just say we assume that was a sell opportunity and we took the sell opportunity. Let's see what happens. Price went lower, so we're in profit again. You get what I'm trying to say? We're in what? In profit again. Where did price come for? Price came for not just this order block, but also for this low over here, a liquidity pool. So now this liquidity pool has now, which was a target, has now become a refer point. So you can decide to take a buy here based on what we observe in price. And when we take a buy there, why are we looking to exit? We're looking to exit above this high, which is a liquidity pool, or at this fair value gap right here. Or probably price may come for this double top here. We don't know yet. We're using the benefit of hindsight. So let's see what price does. Price trades higher into where? Into the fair value gap. Sorry, I didn't draw that line very well. Into the fair value gap. Actually, price trade into the fair value gap. So that's another profit on this particular trade using the refer to target liquidity approach to market structure. So let's just say we took a sell there, because now we are working in context of this particular range, top to bottom here. So we enter our sell. Where are we targeting? We're targeting now this low. This previous target here has now become a refer point, a reference point. So we're targeting this low here, a liquidity pool, and this other low right here, a liquidity pool. And let's see what price does. Price automatically takes out this low right here. You understand? And now if we had held on, we would have made more profits as price went down and on. So have you seen a difference between the approach to market structure using liquidity compared to the classic higher highs, higher lows, retail minded approach to market structure. So if you're able to understand where liquidity is in the marketplace on the buy side, on the sell side, you'll be able to predict market structure accurately. You understand? So I know some of you, it will take you time to come to terms with this approach. All you have to do is watch this video over and over again, and I'm sure you'll be able to understand how to apply this. And mind you, also on this channel, I'm going to be releasing a lot of other um, contents based on market structure that's going to help you identify, okay, why should this market structure actually hold true in terms of liquidity. Why should this area of liquidity actually hold true in terms of market structure? Why should we say sell when price retraces to a fair value gap? Why must we see a buy when price retraces to an order block? You understand? So I'm going to bring out more other contents on this market structure series that's going to better help you better rather understand market structure and directional bias in the marketplace on a day-to-day basis, on a week-to-week basis, and on a month-to-month basis. So price eventually printed out this part in price. And why? Let me just explain this piece of price action. So we can see from this particular candle here to this low here, this is what an imbalance. And right here we have an order block right here. So price traded were into what the order block, filling in this imbalance right here, and price traded lower, and that's the lowest price we've seen so far in this piece of price action. So this is how you use the refer to target approach, the refer to target mentality, liquidity approach to the marketplace, and this will better save you the stress of losing streaks in the marketplace. Mind this is not an holy grail. Mind you, we assume to take a loss, you understand, because eventually if you apply it wrongly, you're going to lose money, you understand. So you want to risk minimal, and you want to better understand what you're looking for in the marketplace. And I'm going to do my best to come up with more content that's going to put you in the right perspective of applying this particular approach to finding the right market structure and the right trend direction. So I hope you found value in today's video. Be sure to hit the like button, also the subscribe button, and share this video to a friend that it could help, and also help them better understand what the market is doing and how to get profitable in the forex market. So thank you very much, and see you in the next video.